Well, it's 1 o'clock, so if you guys are ready, why don't we go ahead and get started? Does that work? Okay, great.
Sounds like a plan.
Great, so good afternoon, everybody. My name is Leslie Remiza. I'm the program manager for the Stephen D. Cutler Center for Investments in Finance. On behalf of the Cutler Center and Babson College, I want to thank you all for joining this afternoon's Investing with Impact panel as part of Babson's Global Entrepreneurial Leadership Week. Before we get started, I just want to mention a few reminders. If you can please mute your microphones during our panelist discussion, we'll have time for Q&A towards the latter half of the hour. But please feel free to utilize the chat feature to send along any questions throughout our discussion. We'll also be recording today's session so that it will be accessible later as well. With that, I'm pleased to welcome our panel of experienced impact investors who will be discussing how investors integrate ESG considerations into their investment decisions. And in doing so, they make a positive, measurable impact without compromising financial returns. Our panelists will discuss how they're providing capital to address some of the world's most pressing challenges and the opportunities for investors who want to make an impact across specific areas, such as healthcare, education, and energy. I'd like to introduce our moderator for today's panel, Scott Perry. Scott is a partner at NEPC and co-leads their endowment and foundation practice. He has over 19 years of investment experience with expertise in modeling and implementation of spending-based asset allocation studies, portfolio construction, and the evaluation and selection of alternative investment managers. He chairs NEPC's Discovery Committee, which is focused on identifying niche investment ideas. He's a senior member of the Alternative Assets Committee and is also a senior member of the Impact Investing Committee. He's a significant contributor to the firm's impact investing efforts, which includes strategy development and manager research. He has helped clients in assessing SRI, ESG, and thematic strategies that best align with their respective missions. Scott is also a member of NEPC's Diversity and Inclusion Advisory Board and has authored white papers on impact investing and the endowment model. Prior to NEPC, he spent time at Ashton Partners and Putnam Investments. Scott received his MBA from Babson and his BSBA in management from Bucknell University. Thank you, Scott, for joining us today. I will turn it over to you to welcome our panelists.
Thank you, Leslie, and good afternoon, everyone. We're excited to bring you this panel today, and as I'm sure you'll kind of hear throughout it, this is a topic that I'm certainly passionate about, but I know Priya and Brian certainly are as well, and with a focus on entrepreneurism this week and impact, those things are really go hand in hand. And I think there's a lot of evolution that has taken place in the impact investing space due to significant entrepreneurial efforts. And so I think it's going to be a great discussion. Brian and Priya have incredible backgrounds, and I thought maybe to start, I'll just turn it over to Priya and have her introduce herself and tell us a little bit about her firm and their fund investing.
Great, thanks, Scott, and thanks for having me here. Great to be with Babson community right now. Always nice to come back. I was at Undergrad 2005. So Impact Engine, we are a venture capital and private equity impact investment firm based in Chicago, and we have a few different strategies in which we deploy capital, all of which focuses on companies whose core product or service, their reason for existing, the way they generate revenues, is directly driving better outcomes and greater access to health, education, economic empowerment, and sustainability. And we do this across a few different stages, as I mentioned. We're early stage investors. We're also growth equity investors. And finally, we're strategic investors into buyout and growth equity funds, and really trying to help many other GPs and fund managers develop the impact management toolkit to be able to help companies build their businesses in this way, as well as hold them accountable to do it. And it really comes from our firm's core belief that, first of all, this is good business, that there are, when you build a company intentionally to essentially effectively serve a certain, your customer, whoever they may be, and you're actually providing a solution that is kind of, there's a market failure, right? Others aren't providing that solution in terms of the effectiveness or the cost or to the certain people. You're addressing that market failure, serving society, and it's a great way to build a nice competitive moat. And at the same time, in order for this to work, it's not just about the entrepreneurs. I think we have a long history of entrepreneurs wanting to do this. Impact investing and social entrepreneurship is not new, but it's something that for many, many years and decades, people had to shy away from because investors assumed that meant they weren't here to make a lot of money and they weren't here to build a great business. And similarly, asset owners, whether it's foundations or endowments, they also may have been interested in this and demanded it. But at the same time, it was decades and decades until consultants and GPs and asset managers actually took them seriously and started building real products and servicing them in this way so that their portfolios and their capital could give them what they want and deserve, which is more than just a financial return. So that's kind of why we do what we do. And I'll kind of leave it there and excited to have the discussion.
Thanks, Priya. And Brian, I'm going to turn it over to you to talk a little bit about your background and Kapoor Capital.
Absolutely. I feel like I found my tribe here today. So I'm excited for this panel today and excited to be with, like Priya said, Babson family. I graduated in 2013 through the MBA program. And, when I came to Babson, I wanted to focus on entrepreneurship. And it really exposed me to different asset classes and being on the other side of the table as a VC. My background is computer science undergrad. Went to Babson MBA and really when I graduated, wanted to focus on how can I help make the world a better place. I was fortunate to land an internship back in 2011 with Kapoor Capital and been with the firm ever since.
I'm trying to print out my monthly statement for a refinance I'm doing.
Can somebody mute please?
I don't see where I can do that.
Okay, there you go. And I had a chance to become an intern. I'm hearing some background noise. If everybody can mute, please. So I had a chance to become an intern through the fund Kapoor Capital. This was through the Babson program, and I've been with the firm ever since. So I've been there since 2011. Became a partner in 2015, and our fund's thesis is pretty simple. We invest in early stage companies that want to close gaps of access and opportunity for low income communities and or communities of color. And that's a very specific thesis. And it's something that I want to talk about more of why we focus on that thesis. But ultimately, we want to create a level playing field for founders like Priya mentioned, that the entrepreneurs have been there. It just needed the capital stack to really catch up. And I feel like right now is a really exciting time. We can talk about some of the historicals of what this landscape looked like 10 years ago and what it looks like today. But it's truly, I feel truly fortunate and blessed to be able to do this work and help, amazing entrepreneurs go out and close gaps of access in education, health, in fintech, so many exciting spaces that we'll get into today. So that's my background and looking forward to the panel today.
Thanks, Brian. Thanks, Priya. Maybe before we get too far along, I think it'd be helpful if we put out a framework around impact investing, and maybe I'll just offer up some initial thoughts, and then would love to get reactions from both of you. I think one of the issues around impact investing is that there's kind of few clear-cut definitions. In some areas bleed into others and overlap and the like. And so as we think about it at NPC, we kind of think about it in a few different kind of buckets. And again, acknowledging that there's plenty of overlap. But we think about historically it was all about negative screening and SRI investing, and then eventually it evolved. And now you hear a lot about environmental, social, and governance and ESG integration in the investment decision-making process, whether it be for public investments or private investments. And then thematic and impact investing, as we're talking about today, has become a big piece of it. And I think that's really where Priya and Brian spend their time, which is focusing on one theme or a number of themes and executing upon that. And that too, again, can be public or private. So that's kind of generally the way that we think about it at NEPC. And I think we'll spend the bulk of our time on that thematic bucket today. But Priya, Brian, would love to get reactions, comments around if that's a similar framework or you build upon that. How do you think about it?
Yeah, I think we generally agree. I think the one additional thing I would say that when I look at it, and I come from a background, I was in the ESG world for a long time actually too, and built a number of ETFs and mutual funds in the space. And I think the nuance that I see it in as well is that ESG investors are really environmental, social, and governance management is a consideration. It's something that the great ESG investors do a lot of fundamental diligence around it because they believe it has financial and material implications. And impact investors, I think, take it a step further where it's not just a consideration, it's actually their investment rationale. It is core to their thesis and why they're investing, and they have a plan and a view and have some responsibility as well for seeing that through, and will be held accountable for that. And so there are many, I think every impact investor actually needs to be a good ESG investor, because if you don't understand all this, then how are you coming to that thesis? But, I think from a quantitative perspective, most assets under ESG are not impact investments. And so there is like a slight differentiation in what we're doing.
Yeah, I think the additional point that I would add on there is, I think when you come to the table to invest and think about impact investing, I think at a simple point, it's this double bottom line of that I'm not going to sacrifice returns for impact. And I think that has always been this challenge, as we kind of briefly touched upon. And there's many different frameworks that are out there. You have the IRIS framework or the Impact Report and Investment Standards. There's the GIN. There's SDG. And I think for us, when we sat at the table and thought about, well, which framework is the right one, rather than try to pick a framework, I think we started with what is the outcome we want to see, and how do we want to hold ourselves accountable and accountable to the limited partners who invest in our fund. I mean, finding alignment there. And we released our first impact report last year, and it was somewhat of a challenge because every company is so different, and we're investing at the really early stages of literally 3 people and a dog getting started. How do you apply some of these frameworks to that early stage company? And where we landed is we ended up creating somewhat of a custom framework for ourselves and how we hold ourselves accountable. And I think as long as you're consistent about that, that's probably the more important piece.
I think, as you were introducing yourselves, you alluded to some of the kind of industries and the businesses that you focus on, but it'd be great to hear in a little bit more detail, where your specific funds are focused, and kind of how you define the impact that you're pursuing. Brian, I'll go to you first. We'll mix up the order.
Yeah, this feels like picking some of your favorite children with the portfolio companies. But I'll give a high level, and then I'll jump into some examples. So high level, the thesis is how do we close those gaps? So if we have a low income household and a high income household, where are the disparities, and how do we actually think about closing up those disparities through our investment and through the work that we do? So one example could be, you think about the health space we invest in. We invest in a space called People Ops Tech, which is just HR tech, along with education and fintech. I primarily spend 80% of my time in education and fintech, especially in computer science education, where if you look at public schools and access to curriculum in computer science, it's severely lacking. So an example of an investment that we've made, let's say in the fintech space is, let's take payday lending loans. These loans are extremely predatory loans, and It's a business model where most folks end up paying back the loans. However, they don't have a chance to build their credit. They don't have a chance to get better rates available to them. And we invested in a company called LendUp, which is essentially trying to get rid of payday lending loans. And in doing so, they allow people to not only pay back the loans that they borrowed, but allow them to start building credit in a way that they no longer need to be taking out a payday lending loan. And that's the graduation that we want to see with portfolio companies. Another example, everybody on this call is obviously probably a Babson alum or a current student, and really thinking about a standardized test that you've taken, whether that be the SAT, the ACT, or the GMAT. And unfortunately, there's many disparities in even test taking. If you have a tutor who can sit next to you and kind of walk you through problem sets versus buying a book in the store versus some hybrid of that. And we've invested in a company called Magoosh, which is $99, all you can eat for test prep. And if you don't get a higher score, you get your money back. How amazing is that? And when you compare it to the alternatives in the market, you're looking at $1,000 products that are out there. And they also partner with a lot of great organizations which give it away for free as well. But the key thing is that there is this alignment of just delivering a low-cost, high-quality product to the market. That's the core business. And I think when we think about impact, we want to think about bolted on, what we call bolted on impact, where you cannot remove it even if you wanted to, because it's core to the business. So that's a couple of the sectors and two examples of companies that kind of shadow what we do when we think about assessing a company and also assessing our success of being great aligned impact investors.
Yeah, there's a lot of overlap between what Caper is doing and Impact Engine. So I will not be redundant, but try to, and just know that there's a lot of shared similarities. But we think a lot about as well in terms of like the end customer, in terms of what's the outcome for them, right? And that's where a lot of our analysis focuses on. And I will say that we, the thing is that we're investing in companies, especially in our growth fund, where we get it. We agree with you, Brian, that it's like you want this to be embedded and part of who they are. That is central to our thesis, but also like a greater appreciation for the reality check that as a company grows up and it has hundreds of thousands of employees, has multiple facilities, has a complex supply chain, no matter how aspirational you are with impact, and no matter how great of an impact that product is having, you can have a lot of other really negative impacts in the way you're running your business that essentially netted out to maybe not being as promising as you were hoping. And so I think when we start investing in companies that are later stage, as well as our earlier stage companies, and preparing them for that, it's also keeping a pretty high bar, as well as being practical, though, around how are you going to do this? Because these tensions arise. And at the very, very basic level, again, I don't care how well you care to treat your employees, you get to a certain size and you get certain ownership, people are going to be talking about your gross margins. And there's going to be a tension around how much you simply paying people, right? And that's perhaps the biggest lever. And so we try to really be partners with management teams who are growing and facing these tensions and expect more of them. So I'll give you an example from our portfolio. We're investors in a company called Footprint, and Footprint makes biodegradable food packaging products. Many of you have probably already used their products. Beyond Meat, their trays are in them, but even Kraft Mac and Cheese, their single serve containers. And they have a particular advantage in this space in that their products are durable. They would withstand heat, cold, from the frozen food out to the microwave. They can sit in oil for 12 hours and still not biodegrade. Yet at the same time, they are fully biodegradable in a modern landfill, not a compost landfill, in the water, which is pretty hard to pull off. So a lot of IP there. And so a lot of people can see that and say, of course, that's impactful. Like, got it. Agree. But what we're working on with them now that they're scaling to be a pretty big company with operations, not just in the US, but Mexico, Europe, Asia, is let's look at the actual energy efficiency and energy and natural resource consumption, like water, that goes into producing your products. And it's the old paper versus plastic conversation at the grocery store. We all can understand that paper comes from natural fibers, but actually the energy intensity of producing that is much greater than plastic. And it's one of the reasons plastic has proliferated over the past few decades, is because it's cheap and it's energy efficient to produce, actually. And so there is a way around that. And with the right prioritization, you can do that. And they've achieved that now, where they're basically at parity with a similar plastic product in terms of what goes in to create it. And by the way, they're almost now at parity in terms of the cost of it, which is huge, because once it costs the same and it's better, then that's what everyone is going to want, right? And so it does come back to that same old question I think Brian and I are still getting at, which is, whoever owns footprint down the road, maybe they'll go public, maybe they'll get bought by a strategic. If they were to say, well, it'll be cheaper for us to maybe not be as sustainable, or, maybe we can add a little plastic in here and not be 100% fiber-based, they're going to lose their customers, because their customers fire their old suppliers because of that. Sweet Green is with them because of that sustainability product characteristic. And we're trying to help build those companies to that stage where it is undeniable. And if anyone tries to change it, it's a losing situation from a competitive perspective. So hopefully that gives you a sense of what we're trying to do. Thanks, Priya. And where I wanted to go next was just, leveraging kind of the experience that you both have in the industry, which is that, I think, and this was alluded to earlier in the conversation, where oftentimes 5 or 10 years ago, we were having conversations about concessionary returns and kind of being defensive about that, and kind of making the case that these were not only impact investments, but also could achieve really attractive returns for investors. Maybe talk about the universe of investments that you see that kind of qualify or impact oriented now versus what you might have seen 5 or 10 years ago, and how that's evolved.
Yeah, it's a great question. So I don't want to assume everybody knows how venture capital works. So I'll really start at the top. And I know, Priya, you do some of these investments from a limited partner. There's a lot of acronyms, so LP, limited partner, of kind of what they were looking for, right? So limited partners essentially are funding venture capital funds, and they're looking for a certain rate of return. I think one of the challenges 10 years ago was it was really hard to even get an impact fund off the ground, because one, there were too many examples of performance that matched what I would call non-impact venture capital. And now that we have some examples, proof points that you can do it, and it's not just this theory, I think we're starting to see some of the attitudes change from limited partners who are more willing to make investments into venture funds. So that capital pool, ultimately, if the VCs can't get the capital, then ultimately the entrepreneurs can't get the capital. And it's a somewhat trickle down of sorts, which meant that there were limited resources or limited capital available for entrepreneurs who, like Priya started this off with, said they were doing these businesses. They just couldn't find the aligned capital. And there was another challenge, which is the venture funds that were getting funded 10 years ago or 5 years ago, I would say they were really early. They were smaller funds because we didn't have those larger, call it $100+ million funds to point to. Instead, what you saw were micro funds. These are venture funds that are typically under $50 million. So what would happen is they would seed these companies, or pre-seed, which really wasn't a thing back then, but seed, the early stage. And the companies would go to a Series A, and then they'll raise a Series B. As you can imagine, the challenge was at that Series B point, there were very few funds that they could go to. So there's this natural tension of sorts, which is if I'm an aligned impact investor, aligned impact entrepreneur, how do I find capital at the seed through series, really through IPO, that can help me get there, where the mission of the company doesn't change? So I think that we're well into that way. I'll talk about Caper Capital really briefly. When we started, people thought we were absolutely crazy. We were a fund that was not an impact fund, that switched our thesis and said, we're going fully impact. And even internally, we had a lot of debates around, are we going to lose great deals? Are we going to miss out on great entrepreneurs? And it turns out it's actually the opposite. We were able to attract entrepreneurs because of our thesis, because of our beliefs. And the most important thing why they wanted us on the cap table was because we were aligned, and we were that counterbalance in some cases to help them go through their impact mission where other investors might not be able to, especially at those later stages, because we were early stage investors. So it's a great time to be an entrepreneur in this space, and it's definitely a great time to be an investor in this space. And I'm proud of the work of the last 10 years, but I will say we still have work to do. And I'm really excited about what the next decade looks like for impact investors.
I think you raise a good point, Priya. Just before I hand it over to you, I was just going to kind of offer our perspective on, the evolution of the industry and the evolution of capital raises. In that, oftentimes, 10 years ago it was the fund one, it was the micro fund, just looking to get off the ground, very little track record, new team coming together, new entity typically, and that's challenging for anyone. But as those investments were made, and then realizations ultimately track record built, we're now at a point where some of the leading firms out there are on fund 3 or fund 4 and really have well-established track records that are attracting really sizable amounts of capital to the space, which is absolutely great to see. And I think, from our seat as consultants, one of the things we hear from those early movers is that they do, to your point, Brian, have an advantage as they think about their ability to partner with entrepreneurs and be aligned in terms of that support of their mission and what they can bring to the table, and that does give them an edge in some of those deals versus the typical investor. So I certainly would echo and reinforce those points.
Yeah, I agree with all that too. And a couple of other things I would just add. One is that, I think we do have to be honest that there is, if you look from a pure returns perspective, there's a long history to this field. And it's evolved many times and will continue. And if you look at the full history, there are a lot of funds that have done really poorly. There are. It's not a perfect track record. And there's more dispersion in SRI, ESG, impact, put it all together, than most of their strategies. And I think there are two reasons for that. One is, I think for a long time, it attracted people who didn't have any investment background, who had questionable investment skill, and were walking around as if they did. And this is still an apprenticeship business. And if you don't know how to invest, you shouldn't be investing. You need to go learn how to do it and then do it. And that was just, sorry, my thing is unplugged. Or my computer goes out. That led to that. And I think there's something's changed. First of all, now I think it's talent arbitrage. And it does have to do with the generational shift. I think people in our generation, millennials and below, and quite frankly, even above, I just think our society is changing where people are more purpose driven. And I teach MBAs, and I can tell you, I see more and more people who don't care to go work at Goldman or Blackstone or whatever. They care to these are finance students who care to use finance for good. And so now I actually think we're seeing a positive selection bias where the impact investment industry is getting some of the best talent. So again, it's still a human capital business. And if we get the best human capital and trained human capital, I think we will outperform. And then the second thing is I do think, again, I think we need to be intellectually honest that it's not always a win-win. It's not. Sometimes it costs you something. And sometimes there's a give up. Sometimes it's a smaller addressable market because of the impact. You're focusing on a certain demographic that's just not so big, or they can't pay as much, or they have high defaults. And it takes a certain level of creativity from an entrepreneur to develop a business model that effectively addresses this in a way where the unit economics makes sense. And by the way, it's also dependent on the investor being sophisticated, because it does come down to valuation. And you should know what you're buying, and you should understand the risks of it. So I think impact investors also unfairly get pushed into a corner a lot. I get asked all the time, are you a market rate investor? And unfortunately, I have to just say yes, when that's not the answer. The answer is, what does a market rate investor even mean? I've invested in hundreds of funds in my career, and I can tell you almost none of them, they all say the same target return for their asset class, and none of them hit it. They're above and below for whatever reason. It's just not that simple. And so I think investors, limited partners, as Brian defined, they need to get more sophisticated and be willing to have a more nuanced conversation. And I think it's impact investors and social entrepreneurs who are in many ways the smarter ones in the room, because they're not trying to say this is simplistic. Like, there is a difference. There are certain business models that are going to yield something different. But I think there's an argument to be made that it's the risk-adjusted return. And I think there are many cases where you can have a lower risk fund. I see it all the time. Like, we're backing an employee ownership fund right now. And the employee ownership piece of it actually creates less risk. But yes, the returns are lower. But the risk-adjusted return, I would say, is very fair and very market. But it's hard for, I think, people to understand that if they keep just asking, are you a market rate investor? Like, put yourself in a bucket. So I think we're entering a phase of more sophistication as more professionally trained investors are kind of entering the category.
I wanted to talk a little bit more about kind of the recent environment, and I know it would have been nice to take a break for an hour from the pandemic, but I'm going to go there just for a second. And one of the outcomes of the past 8 months or so has been an incredible amount of businesses that have been shuttered. But on the other side, there's been an incredible amount of businesses that have been created. So it'd be interesting to hear kind of what you're seeing in terms of opportunities over the last 6 to 8 months, and how those might have varied or evolved, to solve problems. Brian, I don't know if you want to kick us off.
Yeah, absolutely. I think my video jumped out. So I think there's a couple of things. One, it sucks that we're in a pandemic. And here we are, and I don't think we're going to get out of this anytime soon. But what I will say is how it's changed venture for good, actually. So if you think about pre-COVID, and actually a deal that I know Priya, we share in our portfolio in Pad Split. So just give some context. Pad Split is a shared housing model for anywhere from $300 to $600 per month. You get everything you need in a household. You get a room, you get Wi-Fi, you get all your bills paid, etc. And these are folks who typically make under $35,000 a year. So they don't have many great housing options. Some of them are sleeping on friends' couches or sleeping in their cars, and generally working hourly jobs. The company's based in Atlanta. And for that deal, I took a trip to Atlanta because I wanted to meet the entrepreneur. I wanted to see the houses. I wanted to see the experience, and I wanted everything to click. That was 2 trips to Atlanta. I'm based in Oakland. As you can imagine, there's only so much time that you have to work on a deal where you've got to fly into town multiple times. The pandemic has forced us all to adjust our model. Now that same deal would have been done totally virtual. It turns out that venture firms don't stop investing during pandemics. They adjust just like entrepreneurs adjust. I think the second thing is that, if you look at where the majority of venture capital funding goes to, it's generally on the coast. And I know, Priya, you all are based in Chicago, so I'd love to hear your takes on this. I'm based in Silicon Valley, and I can tell you it's definitely a different way of thinking than in pretty much Silicon Valley, Boston, and New York, right? And now we have this inflow of entrepreneurs all over the country, which I'm just amazing. They're not hopping on planes all the time just for literally a 30-minute or an hour meeting. And I think it's starting to even up the odds, because I can tell you this is that founders of color, they're underfunded, to the tune of about 3% of venture capital funding. And when you think about women entrepreneurs, they're underfunding about 13% of venture capital dollars. So my hope through this pandemic is that we start to see funding for more diverse founders, because even if they're not in the backyard of these really high or really expensive geos, that they have an equal chance with great ideas to get funding. And I'm really excited and pumped about that. That is no longer an excuse that VCs can use, myself included.
I love it, Brian. So I'll answer the pandemic question in a second too. But one thing, just because I care about this a lot, and Brian mentioned it, talking about VCs. I think it's really, really important for everyone to know that impact investing is not just venture capital, and it's not just private equity, and it's not just public equities, and the potential for impact stretches way beyond this. So actually, going back to my Babson days, I was a research assistant for Professor Patty Green on the Diana project. And I noted then that most of the businesses cited in that were small businesses. And then I was a research assistant for the Global Entrepreneurship Monitor 1 year too, and noted that globally, a lot of the entrepreneurship were entrepreneurs who are creating jobs for, between 5 and 50 people, not thousands of people. But the amount of, job creation, economic activity, and closing of wealth inequality gaps around the world is coming from those small businesses. And so the same thing is true today. Venture capital is a high risk, high return game. And so it can create an enormous amount of wealth and create a kind of impact with that. But I think that it's really, really important to think well beyond that. And it's kind of time for people to realize that venture capital is actually the wrong investment for most businesses and kind of missing the point in terms of who's really the job engine in this country, in this world. And so in many ways, I think the pandemic, this kind of flows into this a bit. I think, look, a lot of the social inequities that are structural and systematic have just been, we see it now, right? So in many ways, I think impact investors are the canary in the coal mine, except we think we have a solution to get out and don't die in it. We've been seeing these issues already in terms of who's accessing healthcare and education and why there's differences. Even in terms of sustainability, I can even see from, for years, I've seen that, it's actually, there's an interesting thing. There are a lot of corporations who recently want to get on board to fighting climate change, but how to do it, and the companies they're buying from in terms of products and services are almost not at scale for them to do. Like United Airlines wanted to go 100% electric to their on the ground, the transportation vehicles at O'Hare. Why couldn't they do it? There literally weren't enough plugs. Like literally not enough plugs. It's like, and so we're starting to just uncover a lot of these issues. And so I think in many ways, the work we're doing hasn't changed that much. We were also focused on this, the narrowing inequity gaps, right? In terms of who our companies are serving. We're still doing that. We haven't changed that. I think we're constantly trying to iterate and get better. We make mistakes. We're not perfect. And keep, as Brian mentioned, we are based in Chicago and we invest, around the country, but we're really proud that, only 1/3 of our investments are on the coasts. 2/3 are in the middle of the country. It includes, it includes, Bozeman, Montana, to Jacksonville, Florida, to Huntsville, Alabama, Houston. And we think that there's a huge growth potential here that's just being overlooked, all the entrepreneurial potential. And we've already been doing it, but we hope now other people do it because our capital alone won't solve this. We're small, right? We need a lot of other people to do this to actually start to redistribute the ability to have opportunity and growth for individuals as well as society.
Brian, I want to pick up on something you just mentioned, which was, on how you typically connect with entrepreneurs and how it's evolved certainly in the pandemic. So maybe just talk about historically what that's looked like, what it looks like now as far as the way that you are finding, connecting, accessing entrepreneurs, and diligencing their business plans.
Yeah, it's a great question. In some ways, we haven't changed too much. One of the things with venture capital funding is you need these warm leads generally to get access to VCs. And a lot of networks or a lot of people just don't have those networks. Maybe they didn't go to a great school like Babson and they don't have this alumni network, et cetera. So we've always had this open door, apply on our website policy, where every Monday we sit for about an hour or two and kind of share the prospects that have come in. And we generally do a first call. So I think that's the same. A lot of our strategy was based on conferences, specifically conferences where there's just a lack of funding, Women 2.0, or different conferences that might have a racial or gender focus. And those have changed to all virtual. So that has been a big difference. However, I would say that the actual concert circuit has moved to a virtual world. I feel like from speaking opportunities, we're still out there spreading kind of our impact gospel, so to say, and spreading the word that way. The process runs totally virtual at this point. I think we've got it down pat. And actually, it's actually a faster process now too, because of the travel that used to be really the partner meeting that had to be in person. It's now done virtual, and it actually turns out that we can get a deal done in as fast as about 2 weeks, but generally, I would say about 4 weeks from meeting an entrepreneur. So a pretty quick process. I mean, I think that, it's a competitive space too. There's many venture firms, impact and non-impact firms that are looking for great deals, and they also compress those timelines. So sometimes you see a great company and you have to move fast in order to get into that deal, but at the same time, not put your principles away. That way, you're just getting into a deal that's not a good fit for you. But truly excited that we've been able to continue to invest with a pretty diverse portfolio, not only in from a gender perspective or racial perspective, but from a geography perspective as well, which we're pretty proud about. 60% of our founders are not or are diverse founders, and about 1/3, so I guess the inverse of Priya, are not on the coast, and we're still working on that. We want to get that to at least the 50-50 mark.
Brian, just a quick follow-up, in terms of the number of deals that you're doing now, how would you compare it to 6 months ago, 12 months ago? Speeding up, the same?
Yeah, it's interesting. It's slowed down, definitely. I would say in March, April, May, we were just trying to catch our balance and really spending a lot of time with the existing portfolio companies. We've seen this surge now of companies that were in education, that were in telehealth, et cetera, which are just booming. So they're raising Series A's and Series B's. So we spent a lot of time focusing on those companies that were already in the portfolio. To give context, we've got 130 portfolio companies, so we've got our work cut out for us. Typically in the summer, venture, I would say, at least for us, being on the West Coast, is pretty slow. We didn't see that slowdown this year. So we I think it was great. Everybody just somewhat kept working through the summer, and I think we're going to see that. We've already seen it coming into the fall. So I think that we'll end up with the same amount of deals, which is about 15 deals for the year, which is the mark that we hit last year in kind of our forecast.
And Priya, I wanted to follow up with you. You had mentioned around the geography of the deals that you've done recently being different in some ways. Are you observing kind of new, different impact kind of clusters, networks forming, more recently?
I don't know if I notice it more from clusters. I think we're just noticing, and part of it is, I guess my assumption or belief is that it's always been there, but it's more like people are getting more airtime and people are focusing more on these geographies and these people as well, more people of color and women. And because we've been focusing on it for quite a long time, all of a sudden, we have been talking to our portfolio companies, they're getting attention from people who otherwise wouldn't pay attention to them. So we view it as pretty positive, but we're not noticing a big difference in terms of like the activity yet. So we hope so.
Well, we're about 40 minutes in now, and so I wanted to just take a pause and see if there are any questions via chat or those that want to come in. Otherwise, happy to take those. I have a whole host of additional questions that I can want to certainly pose to Brian and Priya, but I wanted to give others a chance to jump in now if they'd like the opportunity. Leslie, can we take questions audio or would you prefer just via chat?
That's up to you, whatever works best for you. It does look like there is one question here in the chat. There's two in there now. Would you, do you want me to grab them? So one student asked, as a prospective undergrad student interested in impact investment as a career, what advice do you have for getting involved?
Perfect. I don't, Priya or Brian, did either of you want to lead?
Sure. Yeah, I'm really passionate about getting more people in the field and spend a lot of time with young folks trying to do this, so I can share my perspective. I think the first thing is you have to know that you need the technical skills, as I mentioned. Like take those finance classes, take the entrepreneurship classes, take it all. As well as, I think at the end of the day, impact investors are better critical thinkers, or just more is required of them. We're not doing anything, we're adding. We're thinking about the financial model, we're thinking about the market opportunity, the team, and we're thinking about, what is the social issue this is solving, and is it actually likely to do it? And we put together logic models and theory of changes, and we diligence that. It's not just what we think, we have to diligence that. And so, when I was at Babson, I actually took way more liberal arts classes than business classes. And I came to Babson for entrepreneurship, and I started a bunch of businesses there. But at the end of the day, I found so much more value as a business person and investor from the liberal arts classes, because it is the context in which business operates. So I would say you need to really understand that to the point where you can problem solve and think critically and have a network. I call people who are researchers and academics and think tanks and nonprofit leaders when I'm diligencing a company. I'm not just calling customer calls and all that. It goes well beyond it. So start developing that. And then I think from a tactical perspective, there are a number of different programs and things you can do extracurricularly, potentially within Babson, potentially beyond that. That's kind of beyond the scope of this conversation. But I would start with Google, like old-fashioned Google. And I think that the field is providing a lot. Look for internships, and you just gotta, if you're coming in knowing you want to do it, you will do it. There is a supply demand imbalance in this industry. There's way more demand for jobs in this space than there is supply, which is again why I think there's a positive selection bias going on. But don't get discouraged. It's because we're not, muni bond traders that are being commoditized and jobs are disappearing. It's because we're in the second inning and the jobs are being created, and it's time to be an entrepreneur. And either with a capital E, go start a business, or a lowercase e. You go find a financial institution, you go find a consultant, go find an asset owner, you go find a GP who's not doing this, and you go teach them how. And I think there's a huge number of jobs that you can create for yourself to go do that work, and it will be hugely important to the world.
Yeah, I mean, just amazing points. I'll start with, I think Priya mentioned this earlier, but it's an apprentice-based business, venture capital specifically. And the best thing that you can do is find a firm where you can learn. And that looks different for everybody. For me, it was an internship. And I had one summer. It was probably like 45 days. And I was hooked. So sometimes that's what it is. And, we run a summer associate program every summer since 2011. And I was in the first class. We still run the program today. So I would say if you're thinking about impact investing, definitely apply. The apps, I think they're going up in a couple of weeks, actually. It's a rolling kind of deadline, but it's a great way to spend the summer. We ran it virtually. So last summer, because of the pandemic, it's a great way to learn. And then I know a lot of other venture firms run similar programs. I just want to throw out one resource because I think that's a common question of, hey, where do I find more venture funds like your fund? Where do I find more impact engines or Caper Capitals, et cetera? There's a great website. It's the Impact Capital Managers. And they have from literally pre-seed to the growth stage funds that have an impact thesis. And if you're looking for whether full-time roles or internships, that is a great list to start from to kind of find those resources. I think the other is don't limit yourself to just venture capital. I think sometimes people forget that there's other things that make you a better investor. For Priya, it was taking some of those liberal arts classes. For me, I started my career as a computer science major and as a developer, software engineer. Then I went to kind of a PM and then kind of stumbled my way of having built products saying, I want to help entrepreneurs who are building products that make the world a better place, that close gaps of access. And that's how I kind of ended up in ventures. So it's okay to explore and navigate. I think that these things don't necessarily leave you, and the things that you learn in different spaces actually do make you a better investor. Absolutely. Because I look at our team, and we have some folks who have no finance background. I was that student before I got my MBA at Babson. I had no clue what a P&L was. Literally did that. I wasn't even thinking that way. And we have people on the team who don't have any finance background, and they actually make really great investors because they bring a different perspective, which is the most important thing.
Yeah, I'd just add a little bit to what Brian said, and I think on a very positive note, I mean, one of the biggest trends that we see in kind of the investment industry is the creation and focus on more jobs that are broadly impact related, whether it be ESG focused research or very thematic impact focused investing. Those are the positions that are being created, being added. Those are the pieces of an existing firm's business that are growing because they see a market opportunity there and they see the investor interest there. So I think there's a really good tailwind behind an opportunity behind those positions certainly in the market. There's another question that came in around typical LPs and funds. And so I can just give a little perspective, and I want to hear from Brian and Priya. We deal with really all institutional investors, public pensions, corporate pensions, endowments, foundations, family offices, and the like. And I'd say the drivers of impact investing in our space has been typically the endowments and foundations, and then to some degree family offices, for various reasons. More flexibility around their capital, more mission alignment, and a desire to do that. And that's really what is, I think, propelled and continue to drive the space. Now it's starting to expand out to other investors, certainly, but I'd say the core of impact investing in the LPs, from my observation, has been in that endowment, foundation, family office space. Would love to hear what you're seeing as well, Priya and Brian.
Yeah, I mean, I spend a lot of time with LPs, as we are one as well, and kind of come from that background. I think what I see is it's the families have been doing it. They've been the first driver and still in the driver's seat. They're less identifiable and more, just more private, and so we don't see it. But they're the ones, by the way, coming to new funds. You know how hard it is to start a new fund? You don't do it without a family office, I'll tell you that, or many family offices. The foundations and endowments, from what I see, and maybe I'm missing it, but I think it's right directionally, is it's more the foundations with endowments than university endowments. I think the university endowments have been pretty slow to impact investing. But the foundations are doing it. Unfortunately, foundations are not a big capital source. They're a pretty small percentage of global investable capital. They can do it all day long. It's not going to make a big enough difference. And I think most of them are unfortunately starting with and limiting it to PRIs, which come from their 5% of their allocation that's meant to be charitable, and they can use it for investments that have an impact like this. We're starting to see more do MRIs, mission-related investing, that comes from the endowment piece, but still, it's not the same. So the scale, what I'm saying, is pretty small. And so it is the big investors out there are the pensions, the sovereign wealth funds, and the insurance companies. And they were very, very behind. And so I think it's amazing the work that Scott, you're doing and your firm is doing, I think, to help these clients. Because again, they need the desire to do it and the consensus, but then they need the help. Like, you can do this very wrong. And if you don't know how to do it, then you shouldn't do it. And so I actually think the biggest lever here is consultants and advisors, which I have seen a huge change in the last few years, hire people and develop the skill set and toolkit to actually source, diligence, and help their clients do this well. Because without them, it's not going to happen, or it's going to happen very poorly.
Yeah, I'll just add one point, which is related to venture and related to impact investing. And it comes down to, when you look at some of these fund sizes, I mean, we talked about the pensions and endowments. They want to write, I would say, pretty large checks generally, and they don't want to own a certain percent of a fund. So if a minimum check is a $10 million check, and a fund size is one of these micro funds, which is the under $50 million, there's just this mismatch of what the funds that are able to be raised at this point. And I think that's changing. We're starting to see some $100+ million funds. But I think that's the evolution that we all hoped would happen, and I think we've seen it internally. Our 2015 fund was a $25 million fund. Not because necessarily we wanted to be that size, but because I think that was probably what was the right size that we could feel comfortably raising. And we're unique because we have this sole LP type of setup. But we do look to the external markets to kind of just test the waters. The next fund was a $50 million fund in 2018. And I think our next fund will be a $100+ million fund, taking in external LPs, simply because I think that the commitment from the LP side is finally showing up. Where these endowments, maybe they have done a fund 1 and are comfortable enough with a fund 2, et cetera. So it's a constant evolution. I think if we have this conversation in 10 years, we'll look back and say, wow, look how far we've come, hopefully.
There's another question I wanted to pick up on in the chat box, which was, I think, more generally about education. So it'd be interesting to hear the types of impact businesses that you're kind of seeing and talking to, especially in as emphasized here, maybe if there are those that focus on secondary or post-secondary students.
Well, I mean, I'll quickly jump in. This is a sector that we spend a lot of time in, 30 plus companies. We actually share a company with you, Priya, in Book Nook. I mean, we share a bunch of companies, but in education specifically, Book Nook and Edovo, which is Chicago-based. And both of those companies are tackling education, one from a reading disparity of how do you help students who are maybe 3 grade levels behind, who get assignment in the class and have these near peer reading groups. But I think that the key thing to note is when we think about education investments, it really comes down to the students. How do we increase the student outcomes? And I get it, there's a lot of things that you can do, but that is the ultimate, I think, lever that we want to pull. And specifically, we try to focus on how do we help students who are on free and reduced lunch when we think about public schools and in equaling or kind of creating this level playing field there. And, if we're investing in a company that's K through 12, we're going to mention that of how many students do you serve that actually have free and reduced lunch? And then when we think about post-secondary, et cetera, maybe it's alternative ways of learning. And a good example of that could be a company, Bitwise, which we've invested in, which is it's a non-accredited program. However, the outcomes is, did you get a job? And this is an entry-level job in technology is the success metric. And generally taking folks who make anywhere from $30K a year, when they're done with the program, they're making about $70,000 a year. And more importantly, they're in these, I would call them tech deserts of sorts, the Fresnos, the Bakerfields, the Oaklands, which are not the San Franciscos, New York, which have a lot of great opportunities available to people who live there.
Yeah, we have basically the same thesis in this space. So I had nothing to add. We can move to other things. It was great.
Scott, I think you're on mute.
Was on mute. Thank you. Wouldn't be a webinar without having one person do that. There's a question about how to access resources, I believe. So I'll just one top idea in your mind as far as preferred websites or networks that you utilized or have utilized in the past to get information around impact space and connecting with investors.
I mean, ICM, which Brian mentioned, is great. We're founding members of that, and it's a great community to look for jobs, and we're increasingly doing research that we're putting out that I think will be helpful. I also think that for those of you who aren't familiar with it, Impact Alpha is almost like a daily industry rag, but it's helpful in that you'll hear about folks like Caper and Impact Engine and learn more about firms doing it, as well as the deals. They kind of post all the deals and job openings as well. It is a subscription-based product, but it's a good one there too. And then back when we're I don't know, who knows what will happen, but the industry conference that a lot of people go to, it can be intense. I kind of think of it as a flea market for impact investors. Everyone's there, but it's still helpful. SoCap is in San Francisco every October, and I always encourage students to go just to get in there and feel what it's like. And you may meet people, but you'll socialize with people. And so maybe next year that'll be in person. I would recommend that as well. And then there are a lot of other things around it. But those are 3 that I think will immediately get you straight into where all the action is, and just be informed.
Yeah, great resources. The only one quickly I'll add is the Techstars Impact program, which is a newer program, and Village Capital. They've been doing this work for some time. And then the Breaking Good by the Case Foundation. You can subscribe to that as well.
Priya, Brian, thank you very much. I know we're coming up on time. I probably have 10 more questions, and I know there's a number more in the chat box. So I'm sure through Leslie, we can kind of facilitate some answers in some way so that we make sure that we round out the conversation. But really appreciate your perspectives and for sharing them with the Babson community.
Thanks for having us.
Yeah,
Thanks.
I just want to echo, now that we're at the top of the hour, that does wrap up our Investing with Impact panel. I want to thank our panelists Priya, and Brian, and our moderator, Scott, for being here with us today to share their expertise and insights on how they're making impact investments to unleash the power of capital for good. So thank you to all of our attendees for joining as well and for being part of today's session. I hope that you all continue to join us for more of our Global Entrepreneurial Leadership Week sessions this afternoon and into next week through the 19th. So thank you again, and I hope everybody has a nice afternoon.
Thank you.
Thanks for having us. Have a good day.
Thank you.